Here's what's coming up on the Peak Financial Freedom Show with Jim and Dan.
With the plan, we got the fees down a little bit to 1.48%, and over the next 25 years, because they had so many assets, it ended up being over a $500,000 fee savings, over $500,000 in potential fee savings.
You have a diversified product set, you have guaranteed income, will never run out, no stock market losses, you have money in the market, we use algorithms to help mitigate the risk, you have money in the bank. You start to put all this together and you start to understand why you should be investing a different way now than you did in the past.
Most people have been told, we've heard, that mutual funds are safer than individual stocks. Well, if you have a stock mutual fund, what is that mutual fund going to be investing in?
All stocks.
All stocks.
Yeah.
So if it's all stocks, how can it be safer than individual stocks?
It's not, it's all stocks. It still has the same risk component.
You're watching the Peak Financial Freedom Show with Jim and Dan, Sacramento's retirement television.
Welcome to this week's show.
We have 30 minutes of great information designed just for you.
Don't go anywhere. Make yourselves very comfortable because the show starts right now.
Hi, and welcome to this week's Author's Corner. As usual, I'm accompanied by Dan and Jim. They're TV personalities, radio talk show hosts, and Amazon.com best-selling authors. Guys, today we're going to talk about going against the grain. And Dan, I'm going to begin with you. And it's all about risk. What's the appropriate amount of risk today for a pre-retiree or retiree?
Well, that's going to be determined by really the individual clients, because we allow and help educate the client on teaching them how much risk do they really want to take, so they can then tell us. We have a very cool risk test that we go through with them, and it has nothing to do with filling out 40 different questions. It really focuses on the one most important thing you got to worry about: risk. And what is that? How much you could possibly lose, and are you comfortable with that amount? So you make sure whatever amount you could lose is in your comfort level. If this is how much you could lose and your comfort level is down here, what does that mean? Pretty simple. You better get that risk down here. Well, if we quantify the risk, we have what we call the golden rule of 5 to 10%, meaning you better not be in a position, even if the stock market crashes 50%, for your portfolio to go down any more than 5 up to a maximum 10%. So for example, if you have $1 million IRA and the stock market crashes 50%, you don't want to go down 50%. We want to make sure that that portfolio, and we try to get 90 to 95% of our clients to have 5% or less projected risk on that $1 million. So the market crashes 50%, you still would lose some money, but how would you feel if you were projected to lose 5% instead of 50% now that you're at retirement? You just won't worry as much.
But Jim, we should just hang in there, right? Just hang in there.
You know, we'll never tell a client to hang in there. I guess when you're 20 or 30, you can hang in there. You have less money, you have time to work, you make a mistake, you can recover. But you're in your 60s or late 50s or 70s, and you lose 30 to 50% of your money, and someone tells you to hang in there, you know it's not right, but you've already gone down so far. What other choice do you have? So we're not going to tell you that. We're going to use different financial instruments. We're going to do different strategies for money in the stock market. We're using stop-loss technology. We're using algorithms to determine the momentum in the market. For the guaranteed income bucket, you can't lose money if the market goes down. For money in the bank, you can't lose money if the market goes down. You start to integrate what we call our 3 buckets into a planning concept. All of a sudden, you get that risk less than 10%.
Well, and if you hang in there, at some point, like 2001 and 2, 2007, 8, 9, you're down 50%. Now you're no longer hanging in there, you're stuck in there.
That's right.
Because what can you do at that point other than stay to try to recover?
Yeah, and you know, there are a lot of tools in the toolbox, right? A lot of strategies, but one of the tools in there, and there's a mixture of these, is the world of annuities. Dan, talk to us about that.
Sure. Annuities probably have one of the craziest names in the financial industry as far as if people like them, hate them, don't understand them. And I think a lot of it comes back around because of variable annuities. A variable annuity goes up and down in value, typically, just like the stock market, just like your current portfolio, and it can have some of the highest fees. We've seen fees as high as 6.5% per year. So if you could lose money and pay that much in fees, why would you really want that? If you then look at the other side of the spectrum, something a little bit more conservative, which is a fixed index annuity that has 100% principal protection against all stock market losses. Stock market crashes 70%, you don't lose one penny. Then if you add an income rider onto that plan, you now get income contractually guaranteed for as long as you live, whether you're single, whether you're married, regardless if the stock market crashes, regardless of what you earn in the portfolio, regardless if you live so long you use up all your assets, they have to continue to pay you income for as long as you live, which is what we want because that's retirees' worst fears, running out of income and not having money to pay things for on a monthly basis.
You know, the beauty is that you have to understand there are different products. You have to make sure you're selecting the right product. You don't overweight these products. You have a diversified product set. You have guaranteed income, will never run out. No stock market losses. You have money in the market. We use algorithms to help mitigate the risk. You have money in the bank. You start to put all this together and you start to understand why you should be investing a different way now than you did in the past.
You know, and it's funny too, because we always circle back to it's about the plan
it is.
that you customize for every single couple or individual that comes in. And you can't know what strategy or tool to use until you've gotten all of that information from that person, correct?
Yeah, I mean, we look at ourselves like architects, right? We're going to architect a plan before the client invests the money. And the plan just isn't your statements or how you're invested. The plan is, what do you want to accomplish in your lifetime? What are your goals? What are your wants? What are your needs? How much income do you need? Do you want the income guaranteed or not guaranteed? How much growth do you need? Are you worried about inflation? Are you worried about long-term care costs? How do we manage through that? How do we put together a plan to lay all that out for the rest of your life? How do we make sure you don't make a financial mistake? And if you do everything right, how do you leave money to the kids and the grandkids? And that's what people want, Dan.
Well, think about it, Jim, because if you have money invested in a portfolio and you don't have a plan and you have goals, what's the chance you're going to hit those goals? You have a chance, but it's going to be low. What if you have every single thing about your money written down in writing that's focused on achieving your goals? What's the chance you're going to hit your goals? A lot higher.
Dan, Jim, thanks so much. If you want more information about anything we spoke about here today, hey, pick up that phone, give us a call right now, 916-452-7325, or go to our website. And don't go anywhere, we'll be right back.
Hi, I'm Jim Files, CEO of Peak Financial, your local resource for retirement and investment planning, acting as fiduciaries for advisory clients. We're offering you a free, worry-free retirement roadmap, including a 15-minute initial call, a face-to-face meeting, a second opinion about your money, a customized retirement income plan, our Amazon best-selling book. You can walk away and keep it all free, no pressure, no obligation, guaranteed. There's no risk and there's no cost. Call now.
You're watching the Peak Financial Freedom Show with Jim and Dan, Sacramento's retirement television.
On this week's segment of We Fix Your Money, you're going to meet Lee and Lynn. They're in their mid-60s, have a large monthly budget, and they're not using their assets for income because they're scared about making financial mistakes, like taking too much risk or running out of money in retirement. Now over to Dan and Jim to tell you how they helped Lee and Lynn.
Thanks, Mark. We're so excited to bring you this week's hypothetical case study. And when you see the data we're going to present to you for Lee and Lynn, you might see a lot of yourself in this. There can be some differences, but there might be the same, general motives and goals and worries that they're having, you might be having, and you can see how we can solve those problems with an actual plan in writing. So both retired, 65, they get good pensions and both get Social Security. So that's kind of nice. They get a double dip there. They have $3.8 million of assets. So they've done an phenomenal job of saving the money, but they're not using it. They're deferring it at the advice of their brokers and their CPAs. They've been married 5 years. This is the second marriage, and they each have 2 kids. Lee's aggressive, Lynn's conservative, which is usually one person's more aggressive, one person is more conservative in a marriage. They have $10,000 in the bank, which was a very low amount, but that's because they have pensions and Social Securities. They felt okay. They have a $14,000 monthly budget, and that's so high because it includes $300,000 in mortgages, which was costing them $3,000 in payments. They want an actual plan in writing that joins them together now financially. They want to handle their big $14,000 budget, and that's because they still have 2 houses. They both had a house before they got married. Now they both kept them. They have $14,000 of net income, and they want to stop worrying about what happens every month. Are they going to be okay? Not having any money in the bank. They want to stop worrying about risk and suffering big losses. They want to stop worrying about their money running out, and they want to be able to plan for their beneficiaries without worrying that they're not going to leave anything, especially since it now is a blended family. So when you look at this type of scenario, that's a lot of stuff, but that's kind of everybody right now that is in a second marriage will have these types of concerns, Jim. So that allows us to start doing some analysis.
So we completed an allocation and risk assessment. They had $10,000 in the bank. They had no money allocated to pay off their mortgages. They had over $3.7 million in growth assets. They had no money in the principal protected and lifetime income bucket. We increased their bank money from $10,000 to $310,000. We set aside $300,000 to pay off the mortgage. They had $1.8 million now allocated to their growth bucket because we needed to reduce the risk and increase the guaranteed income based on what they wanted to achieve in their plan. We put $1.35 million in the principal protected and lifetime income bucket, same $3.8 million. When we did a risk assessment of the plan, they had a 41.7% risk factor. And what that means, if the market dropped by 50%, they're going to lose close to 42% of their asset value. That would mean they would lose about $1.6 million. And that would mean they need a 71.5% rate of return to make up that 41% loss. And that was significant. And it actually was scary to the clients. They had no idea they had that level of risk in their portfolio. We reduced the risk to losing 7.7% based on an estimation versus 42%. Rather than losing $1.6 million, they'd be down about $292,000. And rather than needing a 71.5% rate of return to get back to even, we only needed an 8.3% rate of return. Much more achievable going forward, Dan.
Well, and this all came about by asking them what they wanted their money to do for them and then allocating the assets to meet those goals. So by doing that allocation, it allowed us now to create an income assessment and a fee assessment. And it was wonderful to be able to show them that right now they're not generating any income from their assets. And because of that, they felt poor each month. Even though they had a lot of assets, they weren't generating any guaranteed lifetime income from those assets. So we created a plan that gave them $120,000 per year of income just off their assets, plus their pensions, plus their Social Security. And $100,000 of the $120,000 was now guaranteed for as long as at least one of them lived. Think about that, $100,000 of extra income guaranteed no matter what happened in the market and in their lives, however long they lived, every single year coming in for as long as at least one of them is living. And we only needed to use about $1.35 million of assets to do that. It was a great way to now meet their income goals. Their fees before weren't that bad. They were 2.01%. With the plan, we got their fees down a little bit to 1.48%. And over the next 25 years, because they had so many assets, it ended up being over a $500,000 fee savings, over $500,000 in potential fee savings that they could either use as extra income or pass on to the beneficiaries. So it was a great way then to be able to show them your allocation is going to work really well for you. And then it allowed us to show them what was going to happen on a monthly basis.
Now remember, these clients were taking no income off their assets, and they needed income. You know, in retirement, you need income. That's what you saved your assets for. This is where the clients were when we met them. They had gross monthly income of $17,000 a month. They were paying about $3,100 a month in federal and state taxes. They had monthly cash flow of about $14,000 a month. They had a budget of $14,000. They were barely making it. They had extra $62 a month or $744 a year, which is really, really tight with that level of budget. So to redo the plan and to remodel it, this is how it came out. Now we increased their income to $27,227 a month. Their taxes went up because they had more income to $7,000, but they have net after-tax monthly income of $20,000. Again, their budget's $11,000, but guess what? We were able to generate $9,198 per month of excess cash flow above their budget, which was an extra $110,000 a year, a substantial change to their income, Dan.
And this happened also because their previous budget was $14,000 a month. Now it's $11,000 because we paid off their house. So that's why their budget dropped, but it gave them $110,000 more to spend than they needed. Just think about now, do they feel poor or do they truly feel rich? You're going to feel rich if something like this happens to you. And we then also did a legacy projection that showed what if their assets only earn 4%? What if the bank earns 1%? What if their real estate appreciates only at 1.5%, and they spend all that excess money? They spend an extra $110,000 a year of excess money. By the time they reach age 90, they would have taken out $3.8 million of income from their assets, and they spent it all. And if their assets just earn 4%, the bank earns 1%, real estate earns 1.5%, they're projected to leave $7.4 million to the beneficiaries. So it works great because they get more than enough income to spend, and they still get to take care of their beneficiaries when they pass away. So how about summarize this?
Well, Dan, we couldn't accomplish this without doing a full written income plan up front. A tax plan, a legacy plan, a fee plan, a risk plan, all the things that we talked about in this segment. They were able to pay off their house. They have an extra $110,000 of excess cash flow annually above their budget. They put $300,000 in the bank. They reduced their risk and fees. They can enjoy time now They know their beneficiaries are going to be taken care of, and guess what? They're going to worry a whole heck of a lot less.
So you might see a lot of yourself in what we did for Lee and Lynn, and just imagine planning can help improve your financial security throughout your retirement for you and your beneficiaries, and this is what having a complete written plan can do for you. Back to you, Mark.
Wow, guys, what great results from a great plan. Your situation may not be exactly like Lee and Lynn's. You may still be single or still working, but you can see how planning can help you attain your goals and alleviate some of your worries about money. If this is something you'd like help with, give us a call in the office at 916-452-7325 or visit our website.
You're watching the Peak Financial Freedom Show with Jim and Dan, Sacramento's retirement television.
Welcome back to the program. Now let's listen in on the Peak Financial Freedom Hour with Jim and Dan.
Jim, great to be back for this week's Peak Financial Freedom Radio Show. And we give a lot of data out on our radio show. And I think it helps a lot of people just learning about their money in a very simple way because we walk step by step through the process. So today, we're going to look at questions people have asked us in the past. And we're going to go through these same type of questions because we think it really does pertain to the people listening right now because it's usually centered around risk, income, not having a plan, worrying, all those things. So let's look at Martha. She says, I've had a stockbroker for 30 years in San Francisco. I like him, but how can I grade his performance? I like a local source to meet face-to-face. I've heard you guys talk many times about measuring my risk, calculating my fees, and having an income plan in writing, and I frankly don't have any of these right now. I know I shouldn't, but I actually feel kind of guilty for just thinking about changing advisors. Am I crazy?
No, not at all. And it sounds like she's moved up to Northern California and she does want somebody local. Obviously, we are local. She had a broker for a long time. She's probably comfortable with that person, but if she doesn't have the things that she's identified right here, I don't know how she can go through retirement successfully without understanding her risk and her fees and having an income plan. And that's exactly what we do. We determine how to structure a portfolio to make sure that in retirement it's going to be successful. And that doesn't mean just investing your money. You have to look at different instruments, different strategies. You have to have a plan in place. And all those things she identified, she is absolutely right on. You have to solve those issues in order to have a successful retirement.
Well, and one of the things you kind of alluded to there is we tell people never invest your money unless you have a plan before you invest the money, because you can't just invest the money for a rate of return or hoping it's going to be there or hanging in there writing it out. You have to design the plan, and the plan will tell you how to invest the money to give you the highest probability things will work, because right now she has to be confused because she has no idea if things are going to work, and it's all because she doesn't have a plan, pretty much like probably 99.9% of the people listening right now, right? How about Howie? He says, I've been told many times to invest in mutual funds because they are safer than individual stocks. And if I have a diversified mutual fund portfolio, I can expect annual rates of return north of 10%, meaning more than 10%. All I know is I've suffered large losses in the past. I've never come close to those returns. Is everyone else out there doing better than me? Well, Howie, I think you actually are looking at what you're doing and trying to figure out. A lot of people don't even do that. So at least I think you're one step ahead of a lot of people there. But most people have been told, we've heard, that mutual funds are safer than individual stocks. Well, if you have a stock mutual fund, what is that mutual fund going to be investing in?
All stocks.
All stocks.
Yeah.
So if it's all stocks, how can it be safer than individual stocks?
It's not, it's all stocks. It still has the same risk component.
Well, what if you look at an all-stock mutual fund in 2008, whether it was a growth stock, international stocks, and emerging even more, but if the stock market went down 53%, would it have been normal for a lot of those mutual funds or investment stock to go down about the same amount of money?
Well, that's the general stock market, the S&P 500, which really has less risk in international and emerging markets. Those markets even went down more than 53%.
Small caps?
Yep, maybe 60, 65%.
And then a lot of times people will have a diversified portfolio of mutual funds, and they might have bonds in there, which in the past has helped to diversify the risk. The problem is if you go back to a time period like 2022, and then bonds really got hammered. Bonds lost a lot of money. You could see someone with a 60% stock, 40% bond portfolio be down 20 or 25% for the year, having a bunch of bonds in there. So when you look at returns, it's very difficult to get those north of 10% returns, not necessarily on an individual year. You can on an individual year, but if you look at long-term, very tough, because from 2000 to 2022, the S&P 500 only went up 4.28% as an index per year. You look at 1996 through 2022, every 15-year time period, the S&P 500 only averaged about 5% per year compounded. So it's very tough to get those rates of return. You really have to put a plan together to feel a lot more comfortable, and then we can help Howie understand where his money is. And there's probably a lot of people like that thinking the same thing how he thinks right now. Feel free to give us a call. We'll be glad to give you a second opinion. We'll answer all your questions. You also can go to our website. It has great data, and you can actually schedule a meeting right there on the website, and then we can help you hopefully answer the questions you have that are keeping you up at night.
Thanks, guys. That was some great information. Don't go anywhere. We'll be right back.
You're watching the Peak Financial Freedom Show with Jim and Dan, Sacramento's retirement television.
Some retirees are told they have a diversified portfolio and that they shouldn't worry about anything. It will all work out. But if this is true, why do so many retirees and people planning for retirement worry about their money and even lose sleep over it? Today on Peak University, Dan and Jim are going to be discussing how they help people deal with their concerns around retirement.
Thanks, Mark. Yeah, we agree. We think a lot of people are worrying about their money simply because they're not given a plan and they're told not to worry. Well, how in the heck can you not worry about your money if you don't have a plan and the market's going crazy around you? You have to understand what's going on. When you have that wonderful pie chart, and we call this a beautiful pie chart, which you probably own. When you go in and talk to your advisor, you're probably always reviewing your plan, which they call your pie chart your plan. The pie chart isn't your plan. The pie chart is just how your assets are allocated. And how they're allocated determines your rate of return or your rate of loss. When you look at your portfolio, it might look like this. And you might say, yeah, that looks like my portfolio. Well, you're told many things. You're told you're diversified. You're told you don't have a lot of risk. You're told mutual funds are a lot less risky than stocks. You're told you're not going to lose a lot. You're told you're going to get these great rates of return. You're told it can provide you or will provide you a high level of income for as long as you live, and you're probably only paying about 1% in fees. Well, in this case, when you look at this is your beautiful pie chart portfolio. We also ask you then, how has your portfolio acted lately? So if you've had this type of diversified portfolio and you look at the year 2022, you should have been diversified and shouldn't have had that big of a loss. Well, even if you had 40% of your assets in bond funds and 60% of your assets in stock funds, Jim, what probably happened to you?
Well, you're likely down 20 to 25% because both those assets went down in that year, right? So these type of portfolios look pretty, they look enticing. You will leave your advisor's office and you really don't understand it. And when the market goes down, you lose significant money. You're super upset, right?
It's exactly opposite of what they had hoped or planned for.
Yeah. So we're going to give you an idea of how we do it. We want to simplify this because if you understand your money and how you're allocating assets into different buckets, you will feel more comfortable before you invest your money. So we have 3 buckets.
Yeah, it's very simple. If you use 3 buckets, can people understand it?
Yep, easily, right? So we're going to walk you through the 3 buckets. So imagine you having $1 million and you're going to place your money into your assets. So we're going to tell you how to do this correctly. Bucket number 1 in yellow. That's low risk, low volatility, lump sum access, and low return. So, well, what's that kind of stuff? What's money in your bank, money in treasury bills, money in CDs, right? You're going to need it. We're going to allocate enough money in that bucket to make sure we accomplish your long-term goals. Bucket number 2, where a lot of you have money now, is in the growth assets. Well, what's that mean? Well, good return potential, potential for partial or even full principal loss, and that consists of, well, stocks and bonds and mutual funds, certain types of annuities, real estate businesses, etc. So the people that are viewing right now, you probably have 5 or 10% of your money or so in the yellow bucket, and you have a bunch of money over here in the red bucket. What you probably don't understand, there's a third bucket if you're getting close to retirement or in retirement that isn't used when you're young, but you're used when you're getting to the point where you want to use income. And that's called the green bucket. That's called principal protection and lifetime income bucket. And in that bucket, your principal is protected, you have an opportunity for growth, and your income is guaranteed whether you're single or married for your entire life. And what does that mean, or what is that bucket? It's a low fee, no load. It's called a fixed indexed annuity with an income rider. It's a very specific type of annuity. I know I mentioned the annuity word. We'll talk about that later. But if you look at your assets this way and divide them correctly, you'll have enough cash for emergencies. You'll have guaranteed income to maintain what you need in cash flow, and you'll have growth inside your portfolio with less risk.
Well, now you truly have diversification because you know how each one of these buckets work, and each one of these buckets work differently than each other versus your diversified portfolio of mutual funds. The gold bucket's going to be liquid and safe, and you can use it. The green bucket's going to provide you a high level of income that can never lose if the stock market crashes, and you will get some of the gain when the market goes up. And the red bucket does have risk, but it gives you the highest potential for growth. So depending on how much you put in each bucket, you can control exactly how your assets are going to work, Jim.
So when you look at your portfolio right now, you're probably looking over here on the left-hand side. You have some liquid assets in cash, but the balance of your money more than likely is in stocks and bonds or other asset classes that have lots of volatility and lots of risk. What if you could change that and construct a new portfolio to lower your volatility, lower your risk significantly, get you more income, and lessen your stress in retirement?
Well, it comes down to which makes more sense. Should you at retirement have a portfolio that's made up of cash and growth assets with no guaranteed income and no principal protection? Or should we now diversify the assets in truly a way that can do exactly what Jim just said? So we're going to design plans that uses 3 buckets as we talked about. And our 3 buckets can help you worry significantly less about your money. We're going to have some money in the principal protection lifetime income. We're going to have some money liquid in the bank. We're going to have some money in the growth market, such as the stock market, because we still need growth. When you look at this and you look at how it can be put together with our green bucket, we're going to use the green bucket specifically to help you create the income you need for the rest of your life. Because when you're working, you're getting paid a paycheck. Now you're retired, you have to create your own paychecks, and we can do that on a guaranteed basis that creates what we call pension-like income by using this green bucket, principal protection and lifetime income. Then we need liquidity. We need liquidity so you can feel more comfortable spending the money. And money in the bank is a lot easier to spend than money in the stock market, because the stock market can go up and down. You have no idea how much money you really have. Money in the bank is there, you can use it. And then we do need growth assets so that we can have a fighting chance to keep pace with inflation and have more money left down the road, whether we need it or whether we pass it on to our beneficiaries. So in our green bucket, we're going to use contractually guaranteed insurance products. They're called fixed index annuities with income riders. And I know I said the bad A word. Ooh, Dan said the annuity word. That's true if you're talking about a variable annuity, but in a fixed index annuity, how would you feel if you had a plan that gave you full principal protection, the stock market crashes 70%, you don't lose 1 penny, gives you income guaranteed for as long as you live, even if you lived 120, they'll keep paying the income, allows you to earn some of the gains, not all the gains, but some of the gains, and can actually give you income increase opportunities and put you in a position where you're going to literally pay low fees, usually between 0 and 1.2% are your total fees on something like that. That's a great plan for some of the money. Then we need some money in the bank. And money in the bank, then, we want to make sure is liquid so you can feel comfortable spending it. And then we also want, Jim, money that's in the stock market that is actively managed on a monthly basis to make sure that you are having the opportunity to be in the funds and the stocks that have the most momentum, but we get out of the funds and stocks that have the least momentum, which allows us to put together a great plan. And you might have investment in real estate you manage yourself. You might even want to manage some of your own money on the side that's very aggressive. But this type of allocation now will allow people to have exactly what they want their money to do for them for the first time.
Well, I think everybody now can see if you looked at your money 10,000 feet down, you say, oh, I got all these buckets. How do I place my money? Once you get an explanation and you're educated, you can help design your own plan.
Exactly. Back to you, Mark.
Thanks, guys. I must say, using the 3 bucket system seems to make a lot of sense, and it's very easy to understand. If you have a bucket for liquidity and safety, a bucket for income and safety, and a bucket for growth, seems like a good way to control your assets. If this is something you'd like to learn more about, give us a call in the office right now at 916-452-7325 or go to our website.
You're watching the Peak Financial Freedom Show with Jim and Dan, Sacramento's retirement television.
Thank you for watching this week's show.
And if you want more information about anything we talked about here today, give us a call in the office or go to our website.
And remember, at Peak Financial Freedom Group, we fix your money.
The preceding program is sponsored by Peak Financial Freedom Group.